Meet Kevin. Kevin has a firm handshake, a framed certificate on his wall, and a genuine smile that says, "I care about your future." Kevin drives a lease-financed BMW, wears a watch that costs more than your emergency fund, and refers to himself in his email signature as a wealth management professional. Kevin is also, statistically speaking, quietly destroying your retirement. And the worst part? He's doing it legally, ethically, and with your full signature on the paperwork. I'm not here to tell you. All financial advisors are bad people. Some of them are wonderful human beings who coach Little League and remember your kids' names. But good intentions and good outcomes are two very different things. And once you understand how the financial advisory industry actually works, the fee structures, the incentive misalignment, the performance data, you're going to feel the same slow-building nausea you feel when you realize you've been paying for a gym membership you've never used, except instead of $100 a month, we're talking about hundreds of thousands of dollars over the course of your life. So let's start at the beginning. Because the financial advisory industry in the United States is a $50 billion a year business. That number alone should make you pause, because in any industry where the professionals are that well compensated, the first question you should be asking is, who's paying for all of that? And the answer is you. You are. Specifically, your retirement account, your brokerage account, your IRA, your future. You are the business model. Here's how it works. The most common fee structure in the industry is called AUM, or Assets Under Management. The advisor charges a percentage of the money they're managing for you. Standard rate? Around 1% annually. Sounds small. Sounds almost insultingly small, actually. 1%? What's 1%? 1% is a rounding error. 1% is the tip you leave when the service was fine but not great. Except here's what nobody shows you when they slide that agreement across the desk. Let's say you're 35 years old. You have $250,000 saved. You're going to let this grow for the next 30 years. Assume a 7% average annual return, which is roughly the long-term historical average for a diversified stock portfolio. After 30 years, without any fees, that $250 then grows to about $1.9 million. Congratulations. Now, let's run the exact same scenario with a 1% annual advisory fee. After 30 years, you're sitting at around $1.4 million. That's a difference of roughly $500,000. Not because of bad markets, not because of bad luck, because of a single percentage point that compounds against you every year for 3 decades. The fee doesn't just cost you money. It costs you the compounding that money would have generated. It's a tax on your future paid to someone for doing something you could largely do yourself. And here's the gut punch. That's the average advisor. The ones that actually outperform the market consistently, they basically don't exist, because the dirty secret of the financial advisory industry is that most advisors don't beat the market, not slightly underperform it. Most don't beat it at all. And I'm not just speculating here. The Spiva report, which is the most comprehensive ongoing analysis of actively managed fund performance, has been tracking this data for decades. Their most recent long-term data shows that over a 20-year period, approximately 90% of actively managed large-cap funds underperform a simple S&P 500 index fund. 90%. And that's the funds themselves, not even accounting for the advisor layer of fees on top. You are paying a premium, year after year, for the mathematical probability of making less money than if you had done nothing. And this is where the incentive misalignment becomes criminal. Not literally criminal, Kevin is keeping his license, but structurally criminal. Because the AUM model means your advisor gets paid more as your account grows, which on the surface sounds aligned. If you make money, they make money. Except the problem is, they get paid whether they beat the market or not. They get paid whether they put you in low-cost index funds or in high-fee, actively managed mutual funds that happen to kick back a slice of their expense ratio to the advisor in something called a 12b1 fee, which is one of the more quietly sinister things in American finance and also sounds like the name of a model of robot vacuum. Let me explain how this works. A mutual fund charges investors an ongoing fee called an expense ratio. Within that expense ratio, a portion called the 12B1 fee can legally be used to compensate the brokers and advisors who sold the fund. So your advisor puts you in a fund. That fund charges you an ongoing fee. Part of that fee flows back to the advisor. The advisor has a financial incentive to recommend funds that pay them, rather than funds that are best for you. And this isn't a secret. It's disclosed in a document so boring and dense that nobody reads it, in a font size that requires reading glasses and optimism. And before you think this is a fringe problem, around 70% of mutual fund share classes sold to retail investors include a 12B1 fee. This isn't a bug, it's a feature of the business model. You are not the customer, you're the product. Now let's talk about the distinction that sounds important, but is used more often to confuse than to clarify. There are two categories of financial advisors: fiduciaries, who are legally required to act in your best interest, and non-fiduciaries, or brokers, who only need to recommend products that are suitable for you. Suitable is doing a lot of work in that sentence. Suitable means the product doesn't have to be the best option available. It just has to be not terrible. Imagine hiring a surgeon who said, "I'll operate on you in a way that's suitable." Not optimal, not the gold standard. Suitable, you'd walk out. But in finance, this is the baseline standard for millions of Americans. And here's where it gets really uncomfortable. Even among advisors who are fiduciaries, the title is largely self-applied. The word fiduciary doesn't come with a government certification. You can call yourself a fiduciary advisor and still make money through commissions and fund kickbacks. The terminology has been weaponized by the marketing department and emptied of most of its meaning. So, what does all of this actually look like in practice? Let me give you a realistic scenario. A 45-year-old with $500, zero hires an advisor at 1% AUM. Over the next 20 years, that fee alone, again assuming 7% annual returns, costs them roughly $370,000 in lost growth. If the advisor is also steering them toward funds with higher expense ratios, say 8% instead of 0.05% for a comparable index fund, add another couple $100,000 in erosion. That is a scenario where a person working their entire career, doing everything right, saving diligently, gets to retirement with potentially $500,000 to $600,000 less than if they had opened a Vanguard account and done almost nothing. Now, is there any scenario where a financial advisor is worth it? Honestly, yes. Complex tax situations, estate planning, behavioral coaching for people who would otherwise panic sell every time a recession headline hit their newsfeed. There are legitimate use cases. But for the average American investor who just needs a diversified portfolio and a plan to leave it alone, the data does not support paying someone 1% a year to underperform the market. The index fund revolution was supposed to democratize investing. Jack Bogle built Vanguard on the idea that most investors would be better served by a simple, low-cost fund that tracks the market than by paying experts to try to beat it. And the data has consistently and overwhelmingly proved him right. But the advisory industry didn't collapse. It adapted. It put on a nicer suit, started using the word holistic, built flashy financial planning software, and kept charging the same fees. So here's what you should actually do with all of this. First, if you have an advisor, find out exactly how they're compensated. Ask directly. If they dodge the question, that is the answer. Second, request a full breakdown of every fee on every product in your portfolio: advisory fee, fund expense ratio, and any embedded commissions. Third, compare your portfolio's performance to a simple benchmark like the S&P 500 over the same time period. Not a great market year, not a cherry-picked window, a full cycle. Fourth, if you're in funds with expense ratios above 0.5%, ask why. Because Vanguard and Fidelity have options under 0.05%. The difference sounds small. Over 30 years, it's a down payment on a second house. Fifth, understand that doing nothing in a low-cost index fund, boring, painfully unsexy, requires no human and no annual fee, has outperformed the majority of professional managers over every meaningful time horizon. The financial advisory industry survives not because it creates better outcomes, but because it creates the feeling of better outcomes. The meetings, the charts, the quarterly reviews, they don't generate alpha. They generate confidence. And confidence is worth something. but not $500,000 worth of something. Because the real product Kevin is selling isn't outperformance. It's the comfortable feeling that someone smart is watching your money. And for that feeling, the average American investor pays a fortune. Not in one dramatic moment, not in a crash, but quietly every year, in a percentage so small it barely registers until one day you do the math and realize the most expensive financial decision you ever made was trusting someone who called themselves a professional. So here's where I want to know where you land on this. Do you think financial advisors provide enough value to justify their fees? Option A, yes. The behavioral coaching and tax planning alone make it worth it. Option B, no. Index funds and basic planning tools do the same job for almost nothing. Or option C, it depends entirely on the individual, and the industry just needs better transparency and regulation. Drop your answer in the comments, because based on how split people tend to be on this one, it's going to be a conversation worth reading.